On August 18, 2026, the yield on the 30-year US Treasury bond printed 5.33%. That number had not been seen since 2007, the year before the financial crisis. The next morning, the Treasury Department did something it almost never does. It broke its own schedule. No press conference. No new law. One statement, published mid-quarter, saying it would at least double the size of its bond buybacks. $2 billion per operation, going to at least 4. Yields fell 9 basis points in minutes. The dollar dropped to a 3-month low. Stocks jumped. 24 hours later, all of it was gone. By Friday, the 30-year was paying more than before the Treasury stepped in. Here is the strange part. The Treasury did not print a single dollar. It did not change a single interest rate. So why did borrowing get more expensive instead of cheaper? The answer is one word the press release never used. But first, you need to know who stopped buying American debt in June. Start with Tuesday. The 30-year Treasury bond is the longest loan the U.S. government takes. 30 years, fixed rate. When investors demand more yield to hold it, the price falls and the yield rises. On Tuesday, that yield touched 5.33%. Before the Iran war, the same bond paid around 4.6%. In under a year, the government's longest borrowing cost climbed most of a full percentage point. On Wednesday morning, the Treasury published a short technical statement. It would at least double the maximum size of its liquidity support buyback operations for longer-dated securities, the 10 to 20-year sector, the 20 to 30-year sector. Effective September 9th, running through November 4th. 2 things made this unusual. First, the timing. The Treasury publishes its buyback schedule once a quarter at a fixed date, deliberately, because it does not like surprising anyone. This schedule had been published 2 weeks earlier. Changing it mid-quarter is not routine. Second, the hour. The announcement landed just before an auction of $16 billion worth of new 20-year bonds. The market read it instantly. The 30-year fell to 5.196%. The 10-year note, the one that sets mortgage rates, dropped to 4.647. The dollar index broke below 99, the lowest since late May. Gold rose almost 2%. Equity futures went green. For about 6 hours, it looked like the Treasury had won. Then Thursday happened. The 30-year climbed 7 basis points and closed the day back at 5.26, exactly where it was before the announcement. The 10-year went to 4.71. Everything the intervention bought, the market handed back. By Friday, the picture was worse. The 30-year was at 5.273%. A week earlier, before any of this, it had been at 5.21. The Treasury spent political capital, broke its own calendar, and the long bond ended the week higher than it started. Call that the 24-hour put. A promise from the government that works for one trading session and expires. And that same week, almost unnoticed underneath it, the total public debt of the United States crossed $40 trillion for the first time. Now, the part almost every headline got wrong. A Treasury buyback is not money printing. It is not quantitative easing. The Federal Reserve was not involved at any point this week. Here is what actually happens. When the government auctions a new 30-year bond, everyone trades it. The next quarter, a newer one arrives, and the old one becomes what traders call off the run. Dealers avoid holding it, because if they need to sell fast, there may be no buyer on the other side. Spreads widen. The market gets thin. A buyback is the Treasury walking into that thin market and saying, "We'll take those off your hands." But watch the money. The Treasury does not have a spare $4 billion. To buy back an old 30-year bond, it issues something new. And what it issues is short-term bills. That is the word the press release never used. Bills. The debt does not shrink. Not by $1. The government buys back a 30-year obligation and replaces it with a 3-month one. Total borrowing is identical. What changes is how long the government has locked in its rate. Call it the maturity swap. And this is where it stops being an accounting detail. A 3-month bill currently pays around 3.8%. A 10-year note pays around 4.6%. A 30-year pays above 5%. So the swap makes the interest bill smaller today. It genuinely does. That is not a trick. That is arithmetic. The cost arrives later. A 30-year bond locks your rate for 30 years. A 3-month bill has to be refinanced 4 times a year, forever, at whatever rate exists on that day. If inflation runs hot, you refinance into it. If rates rise, you refinance into that too. The government has moved from a fixed-rate mortgage to a floating one on $40 trillion. Now you understand why the market reacted the way it did. Traders did not see rescue. They saw a government that had quietly become more exposed to inflation. Within days, break-even rates, the market's live bet on future inflation, hit their highest level in more than 2 months. The Treasury tried to lower the price of borrowing. The market repriced the risk of inflation instead. There is one more thing you should know about who stopped buying, because that is the question we opened with. Since late June, the long end of the Treasury market has been in what dealers call a buyer's strike. Not a crash, a refusal. Pension funds, insurers, foreign central banks, the institutions that traditionally absorb 30-year paper, simply stepped back and let the yield climb until someone else blinked. This week, someone else blinked. It was the Treasury, and that is the real signal. One rate strategist put it plainly: the timing was not an accident, and now the market knows where the pain points are. 5.3. Write that number down. The market did. There is a version of this story that ran for 9 years, and it ended so badly that the United States wrote a treaty with itself to make sure it never happened again. April 1942. The country is at war and needs to borrow more than it ever has. So the Federal Reserve agrees to cap the cost. Treasury bills pinned at 0.3%. Long bonds pinned at 2.5%. It worked perfectly. The war debt exploded, and the interest rate did not move at all. But look at what it cost. For the length of the war, that cap was effectively the whole of American monetary policy. The Fed's balance sheet stopped belonging to the Fed. It was determined by how much the Treasury borrowed and whatever the market refused to take. Then 1947 arrives, and inflation arrives with it. Short-term rates have to go up. And now investors do the arithmetic. 2.5% locked for decades while prices are climbing? Nobody wants that bond, so they sell it. And under the agreement, the Fed has to buy every single one, at the price it promised, in whatever quantity shows up. Picture the desk. An insurance company calls in another block of bonds. The Fed takes them. Another block. Takes them. There is no version of the day where the Fed says no. By March 1951, with the Korean War pushing prices again, it was over. The Treasury and the Fed signed what is still called the Accord, and the cap was gone, because the cap had made it impossible for the Fed to do its actual job. And there is a detail in that settlement worth holding on to. Investors who had bought those 2.5% bonds were sitting on real losses. So as part of the deal, the Treasury let them swap into a slightly better bond, 2 3/4. The reasoning was that patriots who financed a war should not eat the loss. That is the 1951 bill. Someone always pays. The only question the government gets to answer is who. Now compress it. Japan, September 2016. The Bank of Japan pins the 10-year government bond near zero and promises unlimited buying to defend it. For years it holds. Low yields, low volatility, exactly as designed. The bill arrived somewhere else entirely. In the yen and in the price of everything Japan imports. And then the closest parallel of all, which is only 2 years old. In late 2023, the previous Treasury Secretary, Janet Yellen, faced a bond sell-off and responded by leaning harder on short-term bills instead of long bonds. Yields fell. Financial conditions eased. It worked. A hedge fund manager wrote to his investors at the time that the Treasury had become uncomfortable with the sell-off, and that while the strategy had the desired short-term effect, over a medium-term horizon, he considered it risky. That letter was dated January 31st, 2024. The man who wrote it was Scott Bessent. So what does any of this cost you? 3 things, in order of how fast they arrive. First, prices. The dollar fell below 99 this week and ended down about 1%, the weakest in 3 months, while money moved into metals. A weaker dollar means every imported thing costs more. Oil, electronics, components, food. That is not a forecast. That happened in 3 days. Second, credit. This is the one that should bother you most, because it is the exact opposite of what the intervention was for. The whole point was to bring long-term borrowing costs down. The 30-year fixed mortgage on August 20th averaged 6.65%. A year earlier, it was 6.58. After the rescue, a mortgage costs more than it did a year ago. Third, the budget. Interest payments have driven the largest jump in federal outlays this year, up $120 billion. Every dollar that goes to interest is a dollar that does not go to anything else. And the Committee of Bond Dealers that advises the Treasury on its own borrowing has already flagged a funding gap of roughly $1.5 trillion in 2027 and 2028. Now, the honest counterargument, because it matters. This is not yield curve control. It is not 1942. Buybacks are a normal liquidity tool, used routinely, and the amounts are genuinely small. At most $83 billion against a market north of $30 trillion. Analysts at Jefferies said flatly that this is too small to change supply and demand in any meaningful way. Another strategist noted it does not solve deficits or inflation, but it buys time and shows the Treasury has tools. They are right about the size. The size was never the point. The signal was. And you may be wondering where unemployment fits in, because higher long-term rates do eventually squeeze corporate borrowing and hiring. That channel is real. It is also slow. Quarters, not weeks. And it is not in the data yet. Anyone telling you it already is selling you something. Here is where it lands. In June 2024, Scott Bessent said publicly that Janet Yellen had taken control of monetary policy through the way she issued debt. Later that year, he wrote that she had distorted the Treasury market by borrowing over $1 trillion more in short-term debt than historical norms. 2 years later, he is the Treasury Secretary. The 30-year is at levels last seen in 2007, and he has just doubled the buybacks and said the number could go higher. The paper that gave the practice its name, Activist Treasury Issuance, warned about exactly this. Its authors wrote that once one party starts using it, every future administration will. They were right. That is the trap. Not that this secretary is dishonest, but that the tool works well enough in the short run that refusing to use it is politically impossible. Whoever comes next inherits a bigger debt, a shorter maturity, and the same button. Asked about $40 trillion this week, Bessent said there was nothing magic about the number and that America can grow its way out. Maybe. Growth has fixed debt before, but notice what the government did not do. It did not cut spending. It did not raise revenue. It did not default. It changed the maturity. Because a government that cannot pay the market price for its debt never announces that it can't. It just quietly makes the money cheaper and lets the price show up somewhere it does not have its name on. In your rent. In your mortgage. In your grocery bill. The bond market did not break this week. It just told you what it thinks your money is worth. And the government listened for exactly 1 day.